Sometimes it works, sometimes it doesn't work, so it's fine.
The sense which I'm getting from some, market observers and market investors is that markets may not fall, but markets will not go high also.
Right.
What is your view?
So I cannot really say whether markets will not fall. So we are hinging based on what is happening to the global markets. So this is a part of a global bull run which we are seeing, and we are participating. And I would say participating less than what we should. A lot of other emerging markets are flying much faster than us. So if we have some sort of a global correction, I don't think India is insulated to that. At the same time, I agree that possibly 18 is a consolidation year. We got a great 17 where we had returns. The indices gave 25-28% return. Broad market was up possibly 40 plus. Can't expect a repeat when the first time last year it happened without earnings growth. So a lot of it is priced in that we are going to get 17-18% earnings growth, sort of is priced in. So I think 18 is, I would say, if you can protect your capital and you look at 19 as a continuation of the bull run, and that would be the right approach. That at least that's how I see the market. Right?
So what does one do? Raise cash, get out of leverage positions? When you say protecting capital, there are two ways to protect capital. Either you hedge or you raise cash.
Yeah, so you can do either of them. You hedge, or you ensure that your quality of your portfolio is better. Momentum stocks, one has to look at them carefully. So where earnings certainty is fairly good. So I think it's time to introspect on the portfolio as far as 2018 is concerned.
I always ask the easy questions because Aisha always asks the tough questions. So Aisha, over to you.
Not at all, not like that. I'm not going to put you in spot, Sridhar, don't worry. But just taking a leaf from Nikunj's chat with Rakesh Jhunjhunwala, and he said that 2017 was great for not just him, but for all of us. But he said 2018 up until 2019 to the run-up to the elections, it's going to be a volatile and testing time. You think once the markets kickstart and start absorbing what the state elections could throw up at us, all the way to 2019 to the big election, it's going to be testing not just because of the global setup, but because politically things could just about move either which way.
So Aisha, I couldn't hear the first part of your question, but if you're asking, given the election year that we face in 18 and running up to the 19 election, I agree with you that we do have quite a bit of election-related news flow which will come. We'll have one coming up in May, which is Karnataka, and then we'll have the big ones, which is Rajasthan and Madhya Pradesh. And I do think, based on the feedback that we get, that it is going to be a close call for the ruling party, both in MP and in Rajasthan. So we could get some negative news flows as we go by. But as many election pundits have said, that 5-6 months is a long time for elections. Things change over a month or so. So I wouldn't take too much of a view based on elections, but when I look at the fundamentals of the market, which is how the macro is shaping up, look at what's happening to the fiscal deficit, current account deficit, trade deficit, interest rates, the way they are shaping up, I would say that we have many more negative news which could come from the macro side. But at the same time, we are seeing a strong earnings growth. So which is why my view, I'm not bearish on the market, but I do expect that it's tough for this market to just run away from here.
We're seeing that struggle already happen. So as an investor, Sridhar, what is it that you do? Do you stick by with defensives? Do you hide in IT and pharmaceutical names? Do you buy stocks which have seen a massive correction in the February fall? What do you do?
So from a sector standpoint, we are quite bullish on the corporate banks. We do think that the entire IBC process is going very well, and this is going to surprise the market. This has been our view for the last 3-4 months now, and we are seeing the first signs of that with the results of Binani and what's happened to Bhushan, and we think this will continue where the bidding could be aggressive, at least for the first round. As a result, we'll see not only the balance sheet of these corporate banks improve because of NPAs getting resolved, we'll also see the P&L improve because some of these will start becoming income earning assets. And we think that the 50% provision is fairly good enough for the first round. But the negative that has come recently is the new norms which RBI has come up with, which is to recognize some of the restructured also as NPA. But on a broad basis, we are still positive on the corporate-facing banks, the private banks predominantly, and of course the retail lenders we've been bullish for a while. But this is more a tactical 18-month play, which we think which could be very interesting.
Right. I have to mark Venki's once again, and the reason why I'm marking Venki's is not because of the 7% price appreciation, but the sheer velocity of the trading activity here. In the first 7 or 8 minutes of trade, Venki's has seen volumes of about 100 crores, which is more than that of Reliance, Tata Steel, Infosys, and even Maruti. It has traded volumes in the first 7 minutes of trade which are double that of State Bank of India and 3 times more than that of ICICI Bank. So I'm just saying that, look, for a company which is not even a $2 billion company in terms of market cap, if such crazy volumes are kicking in, you just got to be careful. I mean, price appreciation should never be a draw for investors to buy the stock. In last 1.5 years, the stock has moved from 500 to 4,000. Yes, I understand there is a change in the reporting standard which is getting better. There is a preference towards dietary consumption after the beef ban, but a 500 rupee stock has moved to 4,000, and the volume just makes you slightly suspicious that what is going on. So I'm not saying that you should dump the stock, but I'm simply putting facts on the table that volumes are too strong for me to digest. There is no way Venki's should be trading 3 times more than ICICI Bank and double that of Reliance Industries. Sridhar, what happens to the banking space now that cost of capital is moving higher? NBFCs will struggle to raise capital because the wholesale channel will also become more expensive. Right. PSU banks nobody wants to buy.
Correct.
Private banks are overowned. So apart from wholesale banks, what else in the PSU, in the banking space or in the financial space?
Given what has happened to the PSU banks, I think the NBFC growth, which was being questioned before,
because of recapitalization.
Yeah, because of recap, I think that comes back. But having said that, I'll be cautious on the HFCs in particular, because when I look at and speak to some of the HFCs, I mean, some of them have 40-45% non-mortgage business, which is basically a LAP loan against property, or it's even to builders. And markets giving 4-5 times book value, I find that very risky. So as I said, one has to look at at each person's portfolio and see whether in a difficult market will these sort of valuations hold. I think the consumer-facing NBFCs may continue to do well. Valuation is a question, but at least the portfolio will hold the test of NPA, given the granular nature of the portfolio. And the consumer-facing banks will continue to do well. So there is, the opportunity set is shrinking, but one has to be careful. I mean, that's all I can say.
In Jan 2017, if I would have said real estate stocks, the answer would have been nah. But real estate stocks in 2017, they were up 2 times, 3 times, even 5 times. Jan 2018, if I would have said IT, the general answer was nah. But all the IT companies have done rather well for themselves.
I'll still say nah.
You still say nah. Yeah. Why is that? Very interesting. Why is that?
If I look at the NASSCOM projection, they're talking of 7-8% growth.
But that's for the industry. Individual companies can do 12, 13, 14%.
So you're talking of stock specific. So let me talk about the industry first. So you're really talking of industry, which is, so the larger guys are going to grow somewhere in that line. Yeah, 7-8%. So basically then it becomes a value stock. So you're really looking at value and not growth. I mean, typically people come in India to buy growth. If I have to buy 7-8% growth, I might as well buy an Accenture or an IBM. My second point is that I think Indian IT industry has just missed the bus by being too much focused on this labor arbitrage, quarter-on-quarter growth, and there was so much of disruption happening So Indian IT companies are broken into silos where each of the employees have some sort of specialization, either testing or some other specific aspects or coding and stuff like that. What is happening with say artificial intelligence, machine learning, and digital is that these silos are getting broken. And I don't think the employees of some of the large IT companies are equipped to break these silos and move ahead and look at some of the changes that are happening. They don't want to disrupt themselves. And I think what is happening in China, look at some of the Chinese companies, the way they have innovated. I'm not even talking of Tencent and Alibaba. I look at
Yeah.
smaller companies. I mean, it's unbelievable the type of innovation that's happening in China, let alone what's happening in the US. So I think the Indian IT company has really missed the bus, and some of the new CEOs were trying to make the change. They couldn't last too long in the industry, but I think they're facing really tough times, and this is a slow death for them. I mean, they will survive, but you're going to have very mediocre growth. Some of the mid-cap companies may do well because they are able to transform much faster. So, yeah, from the low, some of these have done well. But if I take a 5-year horizon from here, are they going to be the game changers? I think it's going to be very tough for them.
Another big na a year and a half ago was metals, but as a house you bought into steel.
Yeah. So
Is the metal a na or metal a yes
no.
now?
So I would have to admit that I'm not an expert on metals, but our house has particularly done well with metals every cycle, and again this cycle we've done extremely well. And given what is happening to global growth, I think this metal cycle will continue for some more time because this is really a global play, and within that we've done quite well in selecting the right stock. So all credit to our team in Enam for getting the cycle right.
You take your point that you were earlier mentioning about corporate banks and the reason that you like them. But does the vulnerability that they have to the fall in the news flow in PSUs not worry you? Or do you only see this as a buying opportunity when they correct in line with PSBs?
I agree with you that given the news flow that we've seen with the PSU banks, we have some of the benefits that we would have seen from the IBC process has sort of diminished. Uh, but if I take the private sector banks within the corporate facing banks, I think they would still hold reasonably well, and some of them do have large exposure to some of these IBC process cases. And as the resolution of some of these continue to come through, we'll see that the provisions that they have made may be slightly larger. However, we do expect that as some of the second line companies come for IBC, the write-offs will be much larger. As a result, that's what we are saying, that a 50% is a reasonable provision, because some of the steel companies, or what we've seen with the cement company, the write-offs have been in the range of 20 to 30%. We do expect write-offs of some of the other companies, say like a gas power plant, maybe 80-90%. So on the balance, we do think that this plays out well and will be a surprise to the market more than anything else.
Interesting to get in those views. What about autos then? Because while January turned out to be a stable month, we've seen some very impressive numbers coming in from Escorts. The tractor sales have jumped up 52%. Bajaj Auto as well just came out with their February sales data. That too has managed to beat the street estimates. Do you think the going is going to be strong for autos?
So actually very interesting that, in one of the conferences, Godrej Agrovet made a presentation, and they sort of gave data saying that there isn't any rural distress. In fact, they gave data to suggest that barring few pockets, say in central Maharashtra or in some pockets of MP, large part of India, there isn't as much of a rural distress as it is made out by media and by politicians. So their view is that rural is doing reasonably okay, in fact doing quite well, and we are seeing that from the tractor numbers. Also what we are seeing with the CV numbers also, they've been quite robust. So we are reasonably bullish on the consumer discretionary space, which includes auto and media. And we do think that these will surprise. Not so much on the two-wheeler side. So if you look at the two-wheeler growth over a period of 1 year or so, they've been much lower than say their averages for the last 4 5 years. So we do not so much on the two-wheeler, but on the passenger vehicle, on the tractor, on the CV side, we do think there's an opportunity.
Sridhar, every market has a theme per se. The theme for last 2 years has been bet on anything which will benefit because of decline in interest rates. What do you think could be the apparent theme? Will it be operating leverage? Will it be financial leverage? Will it be rural recovery? What is that broad theme which you would like to align your portfolio with?
No, maybe we are looking at the GST benefits because
Okay.
this is really a structural reform that has happened. We are going through a lot of teething issues as far as GST is concerned. E-way bill is going to get launched from 1st April. We do think that's going to be disruptive, but it is required because there's so much massive tax evasion happening in the absence of e-way bill. So we do think that this benefits the organized versus the unorganized.
So which is that one category you're betting on? Some are betting on jewelry, some are betting on shoes, some are betting on
Yeah, so
both.
a lot of it, I would look at home improvement, consumer durables, and even autos to some extent, even though they are fully aligned to the GST, but more on the first two categories. And there are many others. I mean, chemicals, many of the others. You have to go individually stock specific and see what is the benefit, and retail, because they were earlier not getting any benefit of the rentals that they were paying. So there is benefit in a lot of the organized sector. One has to look at from a stock specific and see which benefits, which doesn't benefit. But I think that could be a broad theme for the next 3 4 years. It may play out over a period. Not everything will happen overnight, but over a period we'll see this as a big structural.
You know, as a house, the old timers would say that Enam has been very bullish on auto ancillary, and right now there is a lot of debate which is really centered around EVs or electric vehicles.
Right.
What do you think will happen to traditional auto companies, stroke auto ancillary companies, if the technology changes? I've been told that the average car engine has some 300 parts and they will be reduced to 21 parts.
Yeah,
That could be
so that's the
disruptive.
moving. Yeah, that's the moving part, which is
Exactly.
what is required. So I think EVs are here to stay and they're going to disrupt the market. Maybe another 5 to 6 years before we see any mass sort of migration, because it's basically the battery cost has to come down and that's falling at a rapid pace. So I am in that entire EV disruption theory. I do think that many of the auto ancillary companies will be in trouble if they don't disrupt themselves. I do see some of them already, aligned to this, where they have understood that even if there is an EV, it still needs auto parts. So some of them are aligning to this, but I think majority of them will face trouble. But it's about 5 years away from here, so I think it's the space one has to watch.
Let's also, close in with a chat on infrastructure, Sridhar, because within infrastructure, some of these road players have really had it good, right? I mean, just right now, you had a mega order coming in for Ashoka Buildcon. Names like Dilip Buildcon, etc., have seen a huge rally in the last 52 weeks, ever since its listing, etc. And some of these names have also seen a correction along with the rest of the market in February. Do you think roads is the space and that blind spot that you can bet on within infra?
Yeah, so we're quite bullish on the road space. We do have fairly large exposure in this space. So if there is one ministry that has worked overtime, I think it is the roads ministry. And along with that, I'll add urban infrastructure. So at least I know of at least 6 or 7 states where large projects for metros going on. And I've been to many of the rural areas. I was in Uttarakhand about a few weeks back, and the entire hill roads were being redone. There was road widening projects which were going on. So I think if there's one ministry that is working overtime, I think it's the roads. And there's fairly substantial orders expected over the next 3 4 months. In fact, when we met some of the road companies, they were already talking about getting extra lines from banks because they were expecting massive orders to flow through over the next 3 to 4 months. A lot of them would be on the hybrid annuity model. So we are quite bullish on this. We think that some of the road companies which have a fairly good balance sheet and have good execution skills will benefit from this, and we stay invested in that.
So, where are you in this entire debate, Sridhar, as to what would give you sleepless nights? What would you be most concerned about? Would it be the fact that the world at large is now facing this new reality of goodbye to easy money, heightened inflation, and tightening by central banks across the world? Or would you say for us it would be our own internal dynamics? Yes, the global concerns aside, but it's also about growth coming back, earnings pick up, and how across the board they are, and then of course that large looming 2019 risk of the general elections too.
So that's an easy answer for me. You've given all the risks, so all of them. But yeah, the major one would be the U.S. markets or any global shock that we get. So if that would be the first major risk, and of course the 19 is too far away, so I'll not be worried about that. I think I'll be worried about the macro changes that are happening in India, the fiscal deficit, the current account deficit, trade deficit going up, interest rates moving up, inflation going up. So I'll be a bit worried about the macros deteriorating, because if you see the last 3 years, I mean, one of the shining spots for India was the great macro story that we had everything under check. That to some extent is deteriorating. So I'll be a bit worried about this. Elections, I won't be worried right now, it's too far away.
So let's wrap up today's discussion with one take on where do you think some of these so-called haloed overowned stocks are headed, whether it's Liver or a Titan or a Page Industries. These are great outstanding businesses.
Right.
But the P multiples are 50, 60, in one FMCG company it is about 70 times.
Right.
So what do you do here?
So we are not very bullish on some of these consumer staple companies.
But somebody owns them for 10 years, get out of Liver, get out of Nestle, or just hold them?
Yeah, so it depends on the time frame that each individual has. Some of them also have index compulsions, which we may not have. Having said that, I have to admit some of these stocks have done very well. So the people who have held on to some of these stocks have done well. So one of our beliefs is that we cannot own everything that goes up. So we concentrate on things that we can understand better and try and focus on those. Many of the stocks which we don't own will do well. So be it. Best of luck to the people who own them. But we do think some of them will see price correction because you need growth to come back. We know that over a longer period of time, these sort of multiples don't last. So people are discounting 5 years, 6 years ahead. So I would be cautious, or it could be time correction. You may not see price destruction. If the economy recovers and a lot of the other stocks tend to move, these will lag and they'll see a time correction.
Well, we leave it there. Appreciate your time and thank you for joining us. I certainly hope to see much more of you going forward.
Sure, of course. Yeah, thank you.
Well, for the moment, let's take a break. Markets are not going anywhere. Nifty is down 5 points and the Sensex is looking slightly rusty. But even if we consolidate, like I said, after last year's run-up, and given that so much of macro and so much of uncertain global data has been thrown at us, sideways market would be a victory for the bulls.